Hey everyone, so today we are talking about allocation of risk in your portfolio. Like how much capital should you allocate to each trade in your portfolio, given the overall portfolio circumstances, meaning what kind of long positions do you have, what kind of risk defined strategies do you have, and what kind of undefined risk strategies do you have. We at Skill are product agnostic, we are strategy agnostic. We trade where the implied volatility is higher. We try to mix it up between risk defined and undefined strategies. So on the risk defined side, we are big proponents of credit spreads in the futures options market because there is a lot of capital leverage there. You can trade 3 times more positions for the same amount of dollars that you would spend trading any other product, meaning ETFs or indices or regular stocks. So we are big fans of futures options. There's like maybe 12 to 15 underlying tickers in the futures options market for us to trade. So it's really hard to find like a lot of variety in there, but whatever is available, it can give you good exposure to like different sectors of the market, meaning indices, gold, commodities, interest rates, everything. So everything is available on the futures options, but obviously the underlying tickers are limited to probably 12 to 15 for us because those are the most liquid ones we trade. Those are the ones that we understand. We understand their tick sizes. We understand how the markets move. We understand the long-term economic impact on those indices or on those underlying tickers. So therefore we stick to those. And we've been successfully doing credit spreads in those markets. We don't sell naked options in those because the product size is too big. The option contracts, the futures contracts are too big for a retail account size of ours. Our idea and goal is to like help small traders out there, retail traders with 5 to 10K accounts, to grow their account consistently, make some passive income on the side, and do it as fast as possible. Learn the trade, learn the tricks, and then apply those tricks in your portfolio. Today's topic is on the risk of the trade, meaning how much capital should you actually allocate to each position of your portfolio. Now, there was a presentation I did back in May, and there was a slide that I thought I'll just bring that up because it's really important. We follow this quite a bit in our portfolios. We follow it to the T. We don't go all in just one ticket. We try to diversify across ETFs, across different markets, because that gives us the diversification that we're looking for in the portfolio. Because if one thing goes down, the other thing goes up. Although when everything is going down and it's tanking, everything just follows one direction, which is on the way down. And then none of these diversification things work. But when the markets are up and stable and sideways, this kind of technique can actually help your portfolio. So what do we actually do? We keep the risk or trade size to 2 to 5% of the account. Now, 5% is our max limit. We don't even go that far. It's between 2 to 3%. And I'll show you exactly what I mean by that. There's a slide that I did, and that looks like this. Now, the highlighted portions are where is our sweet spot. 5%, it's fine if it's a small account like 10K. And I'll show you exactly how you can do it for $500 in a 10K account with futures options. It's impossible to do in any other market. The reason I say that is because other markets will ask you to put down more money and you will not be able to initiate a trade for $500. Yes, you can do a $5 wide strike for an iron condor or a credit spread, but then your risk to reward ratio is pretty low, meaning the amount of money you're putting down versus the amount of premium you're collecting is not as much as we would like. So we like about $125 to $130 to $50 per trade as premium because we close the trade at 60 to 70% profit, maybe sometimes 50. So out of the 150 that we collect, or 137 or 125 that we collect, we close the trade out at maybe $70 to $80. So that's the whole idea. I'll tell you exactly how much money we put down and how much capital is required for each for this kind of strategy that I'm talking about, which is a simple credit spread in a futures options market instead of a stock or an ETF market where the margin requirements are higher. So now just keep that in mind. If you have a 10K account, if I was trading with a 10K account, my per trade allocation would be somewhere between $500 to $700. That's where I would go. For a smaller account than that, $5,000. Again, you have to increase your allocation to up to 10% per trade, meaning you can only do probably 2 to 3 to 4 max trades in your portfolio at $5,000 because you have to keep some dry powder, some extra cash available for adjustments, for rolling, for basically risk management of the trade. So do not spend all the money in the account. If you have a $5,000 account, you are going in, your max position size would be 10% for each trade, and you can only have 2 to 3 to 4 max trade. Okay. Same thing with 10,000. Your percent allocated to each trade will go down, but your number of trades will still remain the same, meaning you would go from 4 to maybe 6 trades in the 10K account. That's what I would do. This is not a set in stone or whatever. I keep some cash available to me if there is an opportunity in the market, if I want to double down on the current position, or if I want to adjust this position. And then finally, we will take a look at a Zero-DTE iron condor in an SPX today. That's the final piece that I will cover in this video, just to like make sure that you get all the value that I'm giving here. If you do want to like look more into what we are offering in the market, there is a 5-day challenge available, which will be starting within in 10 days, probably, within 10 days, where we will cover basics of option selling, the 3 top strategies that we follow, which are cash secured puts, cover calls, credit spreads. And then finally, we will talk about your personal growth and your personal roadmap. We'll start from the basics of options, trading, option buying, option selling, and then we will go on and talk about more in-depth strategies and how to deploy those in your portfolios. We will also talk about how to set up your portfolios, how to set up your indicators, how to look at checklists that we go through, the IV indicator, the average true range, the volume and open interest. All of those are like really important things to look at before we go into the position, before we start or initiate the position. So let's jump into the trade, and then I'll show you exactly what I mean by spending $500 to initiate a trade in a futures options market. Now, the futures options market right now, these are the tickets that I have available in my paper trading account. I would do exactly the same thing in my live, but here's the thing. I don't see an opportunity today to sell anything in these markets because the markets are not at their extreme lows or highs. So as a contrarian trader, I like to trade at extreme lows or highs. That's where the premiums are juicier and you get more bang for your buck. So therefore, let's see if we can find anything here that we would like to take a position in. ESE mini is down 50 basis points today. It's down about 39 points, about 40 points or something. We can try a position in this one, or we can try a position in CL. Let's try and take a position in the currency market. Okay, I haven't done that yet. It's up 12.65% overall this year. It's running a little bit slow for me, but yeah, this is the euro dollar market, meaning this is the futures market for the euro currency. Okay, now again, we go 17 delta on the short strike, and then we go 45 days out. That's the go-to for our sweet spot. We don't change that mechanics too much. We like to stay between 17 and 20 delta, 45 to 50 days out. Now here, we're not getting 45 days out here, but I'll show you an example in 63-day cycle. If I were to take a position in this, if I were forced to take a position today in any of these markets, this is what I would have done. I would maybe go in the bonds market. The ZB is the 30-year bond market. Again, on its lows, I would like to sell a put spread here, but again, it's not at its extreme. So also we need to check the implied volatility levels. They are pretty flattened out right now. So there's not much vol available in the interest rate markets. The other thing I would look at is this is natural gas. Again, a very big product. Okay, good number here. This is trading at its highs, almost at highs, 4.9, and it's trading at 4.4. So this is a good market to sell some calls in. You can also check the implied vol. It has ticked up a little bit. It's off its lows. It's trading around its average of 60%, 61% right now. Implied vol. Gold is a very big product again, and it's very bullish though. The gold is like a very bullish market. I don't like to sell calls in gold because look at this chart. This would have hurt you. Selling calls here would have hurt you all the time. So because if anything is going right and up, you need to be careful about selling calls in there. And that's the reason why we don't sell calls in gold or in the major indices, because major indices have very big positive grip to it. Meaning if you look at the chart of the ES, yes, it's down today, but if you look at the overall chart for the year, top right, these are the charts we don't like to sell calls in. Again, it's a really good vehicle to trade if it was moving around a little bit too much, if it was moving around a little bit, but again, not many is doing this kind of stuff on the top right. So let's take a position in 6E. I think that's a good vehicle to trade today. It hasn't really moved much. It's up 22 basis points today. It's trading at its highs. So I'm going to short this market. I'm not going to sell a put spread here, but I'm going to sell a call spread. So let's try and take a position on the call side. Again, how do we set it up? We set it up by short 17 delta. Again, one more thing I want to show you is look at the volume and open interest in these markets. So these are the two major columns that you have to look at. Very important. You want to be around where the open interest is in thousands, because otherwise you don't get enough volume, and then you would get, you would get beaten up on the bid-ask spread. So when you try and get into the trade or get out of the trade, it would cost you more money. So you will lose some ticks there. We like to stay where there is more open interest. Looks like there's more open interest on the put side than on the call side. So people are scared of this thing going down. So we will sell the call side and collect some premium on it on that fear. Volatility is up. You've already looked at that. Well, volatility here is probably not calculated correctly. I think it is down, but it looks like the overall market is up for the last couple of days. So let's try and serve a position here at 20 delta, and I'm taking 20 delta because I don't have the full strike at any other delta. So 17 is not giving me a full strike. It's only giving me a half strike, right? So it's giving me 1.195. I don't like that. I stay at full strikes. You can tell by the open interest as well. But on the call side, it doesn't really matter. But on the put side, if you look at the full strikes versus half strikes, sometimes it's more. But usually what we notice is like on the full strikes, there is more open interest. But here it's showing like on the half side. But we will stick to our mechanics mechanics that we have created and frameworked and been working on. 1.19 short, I'm going to sell, I'm going to right click, sell a vertical. And again, I'm trying to show you, if you have a small account, how can you trade with less than $500 and collect a good amount of risk reward, meaning you will put down some money and then you will collect some money. That's the risk reward. You have to divide those two numbers to get to that. From 1.19, I'm going to always go one strike up, which is 1.2, and I'm collecting 12, 11 ticks here. It is. Try and collect 11. Right click and analyze this trade. Okay, so we have to change our break-even points, which would be 110, 2026, and this one needs to come back to 110 so that you have the right chart. 110 is on this one, and therefore now you can see the right kind of expected move here. So again, this is the number we look at, 74, really good pop. This is the probability of making a profit here. You have an over 70% chance of like making $1 here or making 1 cent, however you want to look at it. And then the next thing is look at hover over this line, you're collecting 137. Look at this bottom left. You're collecting 137 and your max loss is 112, $1,112. But look at the amount of money you're putting down to initiate this trade. Now, you're only putting down $306. That's your buying power effect. So your account will be debited by this number, okay? Which means you have paid $306 to collect potentially $137 of this trade. Sorry, 137 minus the commission. So when you do this in your real account, this commission goes up to $7.15 or something. So I always have this $15 number in my mind for going in for a two-legged trade, going in and getting out. That's a $15 charge. I always have that number in mind. No, I don't look at this $4 something of, because this is not the right number. When you try to do this in your real account, this number will go up to $7. So yes, futures options are high in commissions, but look at the risk reward. Now I am risking, let's just do the calculation here. So I'm risking $306 to make $137. Now 133 minus another, actually let's do this, 137.5 minus 15. So my potential number is 122.5 divided by 306. Now also remember, this 306 will not stay static. It will move with your volatility in the market and how close you are to expiration. But again, it will not double up to like 700, 800, right? It will go up to 350, 400, then it will come down again if the markets are moving in your favor. So that's a 40% return rate. The risk reward of 4 to 1 or at least 3 to 1. And risk reward, you're risking 300, you're making 100, let's say. That's a 3 to 1 ratio, right? A really good risk reward. That's the number I look at. And then I would like to give you a comparison as well. So let's say we are collecting 137 here, right? Keep that number in mind. Now let's try and do this trade in a cash index, which is SPX. The index is actually down today, so it would be a good vehicle to like sell something in there because the volatility is up. And I can show you that if it lets me not. Oh, yeah, okay, here it is. SPX. I'm just showing you a Zero-DTE trade in SPX, and let's see the margin requirements here. So again, like I said at the beginning of the video, I'm going to show you a Zero-DTE trade in the SPX market, and then I'll show you a less than $500 trade in a real futures options market, which I just did. You paid less than 500, so if your account is 10,000, you can probably do at least 3 or 4 of those, maybe 5 or 6 if you keep the risk minimum in your portfolio. When I say minimum, I mean only spend less than half of that 10K. So your buying power should only be max 3,500, 4,000, maybe max 5,000. That's 50% buying power, right? So that's how much you should be spending in this trade. Anyway, let's move on to the Zero-DTE trade and then see what the buying power effect here is. Again, now Zero-DTE versus a long-term trade there, obviously there's a difference, but overall, your Zero-DTE will always charge you more margin, but it's only a little bit more. So if you want to compare apples to apples, we could do a iron Condor 45 to 50 days out here versus over there. It will give us the same result, but the Zero-DTE will also give us some indication of like how the margin works in these cash products versus the features option. Okay, so Zero-DTE iron Condor at 16 delta. Before I even put this trade on, I can tell you my expectation on this. The volatility has ticked up. There's only 2 hours left, maybe 1.5 hours left at market close right now, Pacific time. So therefore, I'm expecting to collect probably $2. In terms of dollars, I'm probably looking at $150, maybe 200, maybe more, maybe 300, 350. So that's the range that I'm looking at. If you're selling both sides, that's what I'm expecting. If I'm selling one side, obviously it's cut in half. And then actually, let's just do one credit spread example so I can show you the apples to apples trade with the other features options versus the one here. First, let's just do this at a 45-day, 60-day. Let's do a 42-day. It's just 69-day. Okay, this is the number. Actually, that is not a monthly cycle. I'm looking at the open interest. Okay, high open interest here. And because the SPX market is down today, we're set a put spread. So let me sell a put spread here at 17 delta, 61.50. I'm just showing you the difference between a futures options market and a cash product market. Okay, there is no comparison of a futures options market to anything that is available in your broker account because futures options are basically the most capital efficient products out there. And don't worry about the risk. We cap cut the risk by defining the risk here. They basically give you the exact same exposure of the market as this product would. Okay, so 6150, I'm going to go a 20 point wide, trying to make it more comparable to a 6130, maybe 6125 from 6150, 35. That's not available. Okay, 6140. Okay, $1.15. I think that's a more comparable product, more comparable trade. So let's look at the margin requirements here. Let's see just for comparison to see how much money will you be putting down for this kind of trade. Okay, break even. Select 116 here. 116 already on top. 83%, really good pot. I normally target 80% and plus. It gives me peace of mind, peace of everything that, I can sleep through the night. In this product, we're collecting $110, but look at the margin requirements. Again, I can tell you now, the fees are going to be lower here, which is totally fine. It's half, maybe less than half. But again, you're putting down 3 times more money. That's $910 versus $300 on the other side. So you can do 3 of those trades on the other side on the futures options market for 1 trade here. That's why I said 3 times better capital efficient gain from futures options. So let's say we collected $122 on that side. You do it 3 times, you can add up 3 contracts in that trade, and that's $366. But if you do that, obviously your risk reward does not change because it will then ask you for more buying power. But we are collecting $122 for $300. That's 40%. Here we are collecting $110. Let's say the same amount, right? 130, 122. But we're putting down $900 for doing that. The return number goes drastically lower. Same amount of dollars collected, same amount of everything. These are the exact same products because they follow the market exactly the same way. I can show you the returns and correlation of these 2 products for the last 20 years, and you can just see that they follow each other to the T. Okay, so there's no drag anywhere. There's no active risk. There's no nothing because this is how it is. The products are built to track each other, to track the market, and therefore one provides good capital leverage, and then the other one is more of a capital drag. Last the comparison. Let's go through a Zero-DTE trade. I'm just fascinated to trade this one today. SPX. I just want to put a trade on and see what happened in the last 1.5 hours of the market. There's some volatility today, although the markets are moving quite a bit. It's only down 25 points. My instinct is telling me to sell a put spread here to go long because that's the kind of like a contrarian trade. But I also want to tech this Zero-DTE and Condor sell up and see how that goes. So let's do it at 17 delta on this side. So 6-1, and let's do it 20 point wide iron Condor. Okay, 20 point wide, 6170, 6150, and then on the other side, I'm going to go the exact same 17 delta, and then I'm going to select a 20 point wide long option. It's just moving a little slow. I'm going to keep going. Oh wait, I'm in the 69 day cycle here. That's number one. I need to be in that's why it kept going. And I was like, why is it kept going? The Zero-DTE option should only have a few strikes available, not that many. Okay, but this is the trade we want. 20 delta. Okay, 66.75, 66.50. That's not going to work because look, if I go 25 points out, I don't have any delta available here on this strike, on the long strike. I'm more worried about the long side because it will be hard to get the trade in, hard to get in and out. So I'm going to go 20 short and then I'm going to go only 10 points wide. Yeah, let's do a 10 point wide spread here. Vertical, not vertical. It's an iron Condor. So sell and iron Condor. Okay, 10 points wide. So I'm going 66.65. Pick that up. And the other side, 20 delta again. What do I get here? 67.15. Okay, that's fine. 67.15. And then 67.25. Okay, so my trade is set up. Let's see how much money I collect or the amount of risk I'm putting on. Obviously, buying power will cut down because I'm selling both sides. When you sell both sides, they only charge you capital for one side of the trade because the market can only hurt you on one side, right? Beyond your short strikes. You put down capital or your buying power is affected on one side only. Okay, let's bring it in. Still don't see my chart. There it is. I see something. Still thinking about it. Boost go. Okay, there it is. Okay, that's the chart. I need to change the break-even points. 11.8. And I'm going to change these to 11.8. And you will see the gray areas will then compress and come closer to each other because that's the end of the cycle, right? So selling on November 7th. For some reason, they do not do the slowness of this is more helping. But anyway, this is the chart. 11.7 and 11.8. Okay, yeah, that's fine. Let's look at max profit, max loss, break-even points. I'm bang in the middle here. That's a good point to start the trade. That's how we initiate iron Condors. Something's up with this chart, or because it's my paper trading account, it's probably doing its thing where it's not getting the right setup on the chart, which is fine. Don't need to worry about that. But so it's trading at $2.80. Let's look at some Greeks here first. So we are slightly short on delta, like -2. It's totally flat. Theta, obviously, this is where most of our money will come from. So you see we're collecting 280, 277 of it is from theta decay between now and market close. A little bit of it is vega, so all you need to worry about is the decay of this curve, decay of these options, and that's how you will make money. Okay, so right click and confirm and send. I'm putting down 720. It's always $1,000 trade if you are 10 point wider. If you were 10 point wide on the strikes, it's $1,000 trade minus your premium you collect. That's the amount of money you put down. So we are collecting how much? $280. 1,000 minus 280 is 720, and that's the amount of money the broker is actually asking us to put down to initiate this trade. And that's how it always works. There's no capital leverage here in the cash markets. If this were the futures option market, we would have put at least half of that. Not a third less, but maybe half of that. But that's it. Let's see if we can make any money in this Zero-DTE. This is a good way of trading and learning in your paper trading account, and it's already filled. So I'm going to recheck this. Got filled at $3. That's good. $20 extra. Got filled at $3. Yes. So I'm going to recheck this trade, in an hour or two and see how it goes. I will finish this video then when the market is closed. So stick around and I'll be back shortly. Thank you.